Hello students, and welcome to the topic of extrapolation. Well, in another week we've already talked about demand forecasting. What we do today is a bit similar, but now what we actually look at is how we can project financial statements. This is a little bit of a different story. So let's get started. There are a couple of things we want to do. We look at this percentage of sales method, high-low method, linear regression, which is already something that we touched upon, so I'm not going to go that deep. And then we actually look at how to forecast the financial statements. So let's give it a start, let's give it a try. And I would like to, first of all, explain you a little bit the background. You can see on the slides, first of all, it's quite a lot of information that you can find there. So what I will do is I will not read out everything, but I will give you summaries, basically, in my own words, what the slides tell you and what the main message of each slide is actually being. So let's start. So you can see a diagram here. You can see X and you can see Y. And let's say we have a company, we make certain sales promotions, and let's say X is the amount of sales promotions that we put in, and Y would be the amount of resulting sales that we have. So let's say we've tried two things. We've tried this part, we measured part A, so a certain amount of sales promotion and a certain sales, and also part B. And then there are two terms, interpolation and extrapolation. If you want to measure a point between A and B, like C, it would be interpolated, because we take measures, two measured points, and try to find out what a certain point in between those 2 points is, and that's called interpolation. But if you want to find out what D is, so outside of the scope of our measurement, it would be called extrapolation. That's basically what we want to do. We want to find out what different values of the balance sheet, income statement, and cash flow statement are. We want to extrapolate them. So, and that is basically everything that you need to know about this slide. So, from known facts to not known facts is what we want to get to. So, then extrapolation is basically a kind of projection. And a couple of weeks ago, we already talked about budgets. And we said budgets are basically a pool or a planning of resources. So resources can be money, can be hours, can be whatever, but usually expressed in monetary terms. And usually what we try to do is take a budget and extrapolate, because the financial statement in a certain sense is also, if we plan, let's say the financial statement for the next year, is also kind of budget planning. How much money do we want to get in? How much costs do we probably have? And basically, that's what we do with the financial statements. And if we project the financial statements, it's also called pro forma statements, like you can see here. So it's about the future financials of the company, and basically we consider what the past told us about this company, about our company. So let's say, how did the past sales figures develop? How much were the costs in the past? And we combine that with external market factors, like what is the general growth of the market at this moment? What do our competitors do? What do we plan to do? And with this information, get to a clearer idea of what the future of our company could look like in terms of the financial statements. So, the percentage of sales method and some pitfalls. Well, percentage of sales method is basically having a look at the estimated annual sales growth. So let's say we plan to grow by 10% in that company. Let's say our revenues should grow by 10%. Then we can relate everything to this 10%. In a simple version, this happens. So all the items in the income statement, balance sheet, and cash flow statement are simply related to this 10%. And then basically we have the pro forma statements, so the projected future statements. But this is a little bit of a problem, because there are some items where it doesn't make sense. Like, for example, non-current assets should only grow if we reach our capacity limit. If we still have 5 machines running, let's say, located in our company that we never used because we never needed them, of course it doesn't make sense to buy new machines, but to use the old ones before, or in general to use the full capacity of our machines before we buy new machines. The same also goes for bank loans. We don't need to get bank loans if we have enough cash lying around. if we have enough money ourselves. So also bank loans only need to be taken on if necessary. And the same also goes for some expenses, because some expenses are not variable, so they not increase with the volume, or we could then say if we have a sales increase, also a variable cost increase. But some of them are fixed or semi-fixed. So only the variable part would grow at the same rate as the sales. So that's why we have to split certain costs. And you can see that these are some pitfalls. These are some pitfalls that we have to take into consideration. So it's not as easy, and we have to basically see which item grows with which rate. So this is an example that we have here. So let's say this is year 1, year 2 of our company, revenue, costs, the profit, and whatever, so the complete picture. And the question now is, all of these items, how do they behave? Well, the starting point is always the turnover. Well, we say the turnover should grow, let's say, by X, and X in this case, let's say X equals 10%. So we'd say our sales should grow by 10%, then turnover, well, grows by 10% in year 3. Then every item that is directly linked to the sales should also grow by X, by 10%. So we have to go through that list. And we see that some items include variable and fixed parts, so of course they don't grow at the same rate. But let's say, for example, cost of sales are directly related to sales, so they should grow the same rate. Gross profit is simply turnover minus cost of sales, so of course this also should grow by 10%. But then we have general expenses, and like I said here, some items include variable as well as fixed costs. And if fixed costs are fixed, even if we have a slight increase of turnover, those fixed costs will stay fixed and will not be affected by this increase. So only the variable parts. So this means basically we have to split the general expenses according to variable and fixed. So let's just look at the general expenses. There is a variable part, and there is a fixed part, or might be a fixed part. And of course the variable part, if we grow our business by 10%, also the variable cost should grow by 10%, but this will stay fixed. So it grows by 0%, unless there is a step in the fixed costs, but this would be indicated if the new factory is something like this. And there are also some items which have nothing to do with the sales, like we said before, the loans or the interest expense on the loans. Well, they of course depend on the loans. Loans do not depend on the sales growth, because as said before, we only need a new loan if our current financing is not enough. So this would be independent. Also dividends are independent because we can decide on them on our own together with the shareholders. And here you can therefore get a first picture of how to extrapolate the financial statements, or in this case here the income statement. So, and that's what we're going to deepen. This knowledge is what we're going to deepen on the next slides. So I just go back one slide. The general expenses, like we just said before, have a variable and a fixed part, or might have. That's why we would have to use certain cost splitting methods. And there are particular two, which is the high-low method, and also linear regression, that is very well suited. The first ones that I have here are just some ideas, but they're not very accurate. The first one would be simply classify each of the items and say they are either fixed or variable. So we could say, well, general expenses have more variable part, so we classify them as completely variable. This is not as accurate. This is easy and helps the company to make quick projections, but it's not accurate. Because of course it's not true that this is completely variable. Well, then what we also have motion and time studies to see what exactly the variable and fixed parts are. That's very good, but very time consuming. And finally, a visual fit method, simply putting the data on a line and then trying to visually see how far the points are apart and what the variable and fixed costs are. Well, this is also simple, but also not precise. So you can forget about the first three. It's simply to let you know they are there. But now we get to those that we can actually use. High-low method. High-low method basically means we take the lowest point in our observation. So let's say again, so this is the sales output. So the sales turnover, so 100 million, 150 million, and certain operating expenses, so 90 million, 125 million. So let's say at 100 million turnover, we have 90 million operating expenses. That's the lowest point. We take the lowest point and the highest point. And let's say the highest point that we have measured, so if we look at the last income statements, we can see the highest turnover we made was 150 million, and there we had 125 operating expenses. Then what we can simply do is relate that to each other. So we see 100 output is 90 expenses, 150 equals 125. And basically what we then have to do is simply relate this to each other and see, well, what is the difference? The difference of sales between the 2 points is 50, and the difference between the operating expenses is 35. So if we then take the 35 and divide it by 50, so 35 divided by 50, we get to 0.7. So this, or 70%. This way we know that if we make €1 in turnover, we incur 70 cents in variable cost. And this is a very, very good observation, because then later, and I will also show this to you on the on a task that we do, we can actually say, and we can also do that here. So let's just take then we can take any of the situations. Let's take situation B. We have operating expenses of 125, and of course there's a certain variable part in there and a certain fixed part. So we know the total costs are variable plus fixed, and if we know that 70% of revenue is cost, then it's going to be very easy. So then we have 125 euro equals to variable plus fixed cost. So 125 euro equals variable cost, and we know variable costs are 70% of sales revenue, because if we have €1 in sales, we have 70 cents in variable cost. So it's simply 70% of the 150, euro, and then plus the fixed cost. And that basically is what we have to calculate now. So what we do is we take 70%, so 0.7 multiplied with 150, so that is 105 euro, and so 125 euro equals to this plus the fixed cost. And then simply what we have to do is trying to get the fixed cost standing alone, so minus 105 euro. So to get this on this other side, we would have 20 euro as our fixed cost. And this is the way we would calculate this. So we simply take the difference, relate the difference to each other, then we know we have 70% or 0.7 per euro that we make turnover, and then we can simply take this information and put it into the formula. So in total we had this amount of costs equals variable plus fixed. So 70% of the revenue is then the variable cost, so 105, and then we take it to the other side. We can do the same thing also for the situation A. Situation A, we have a total cost of 90, so 90 euro equals to variable plus fixed cost, and so 90 euro equals variable, and that's 70% of the sales turnover. Sales turnover is 100 euro plus fixed, and then we have 90 equal to 70 euro plus fixed, and this minus 70 then would be 20 euro equals fixed. And so you see in both situations it works. So we know our fixed cost per observation are 20, and the other part is variable. And so this is the way that we can calculate or use the high-low method to calculate our cost breakdown, basically. So you can see that also here again on the slide. That is simply what we just did on the board. So we related to each other, and then also the 20 is the fixed cost that we have. Problem for this is, of course, if we have, let's say, 5 years of data, we only take the highest and lowest. So we ignore the vast majority of data that we have, which is, of course, a disadvantage. But this is the way we use the high-low method. Then another method that we can use is the linear regression. And like said before, we used this already in another lecture, so we don't need it anymore today. Or we don't need to go into depth with it. But the good thing about linear regression is that it takes all the values into account. It's of course more difficult to calculate, but it takes all the values into account. And that's why basically here we can might have a more accurate result. I'm not going into details as said before, but this is what we can basically do. And there's one thing that we didn't discuss yet. Sometimes you see the r squared. So we never learn how to calculate this, and this is not a problem. But the r squared basically means how close the line is to representing all the individual points. And the closer the r is to 1, the better it actually is. So that's something we have to take into consideration. All right, so I hope this is more or less clear to you. You can also have a negative correlation. There would be minus 1, so there would be a minus sign before that, and then you would have a negative correlation, but also there, -1 would then be the best state that we could have. And you can see that also here, the further dispersed the points are, the lower the r squared actually is. All right, let's now come to some of the problems in data collection. Well, sometimes you do not have all the data available because some documents are missing, and this of course represents a big challenge if you want to perform an analysis like the high-low method or the linear regression. If you don't have all the data available, then sometimes you have outliers. So this actually means if we have a diagram here, actually we have a quite nice distribution. We might have a point here or there or whatever. And these are called outliers, and they might destroy your data. And so you have to see that you can somehow get rid of them in your data set. Well, sometimes also, if you look at the highest and lowest point or linear regression, you collect data from different years. And this is a problem because data from 3 years ago might not be applicable anymore to today. And that's always a bit of a tricky part. So then what's also really important is part D. Well, usually what you want is a large data set. But the problem with this is also that you want recent data. So you have to take a decision if you want to have recent data, let's say a small amount, or a huge amount of data, but maybe outdated. And that's also, well, it's a bit related to what we said before, but this always is a bit of a tricky part. Do you decide for short periods or long periods, more or less data? Because you can of course not in the same period measure everything. That doesn't work. So there's always a bit of a trade-off that we have here. And also, the past might not necessarily reflect the future, so past data might not be sufficient in forecasting or projecting the future. Well, let's start with projecting the income statement. So we use the 10%, let's say we use the percentage of sales method, and let's say we use a 10% growth of the items. Well, we talked about this already. We have to look at which items are closely related to sales, which ones are not. So let's say COGS are closely related to sales. Some expenses we have to use high-low method, and also interest rate is usually unaffected by sales growth. Tax rate, dividend ratio is also unaffected. So I will not read out everything here on the slide because this is basically what we dealt with already. And later when we do a task, it will hopefully be very clear to you which items grow with the sales and which ones not. So if you look at the balance sheet, also here, the working capital items, which are working capital simply means current assets minus current liabilities, but those are expected to grow with the sales growth, because if we grow with the company, we also need to have the supporting resources. And the supporting resources are like inventories, receivables, but also our payables, because we need, let's say, resources that we buy in. And, well, important is also that some items do not grow with the sales growth. Like we said before, the non-current assets are usually independent of this, or non-current liabilities and the equity, which basically has a life of its own and only needed to increase if there is, let's say, further financing needed. Efficiency ratios don't change because the working capital items stay the same, so here we also do not have to worry. Well, then we have one topic before we actually can start with really diving into the forecasting, the discretionary financing needed. And this is a very fancy term, simply meaning what kind of additional money do we need if we want to grow. So if we want to grow by 10%, how much more money do we need? And this is called DFN, discretionary financing needed. And usually, if you create the pro forma statement, so if you project your income statement, balance sheet, and so on, they will not balance because somehow the growth needs to be financed. And that's the last step where we take. The last step would be to balance everything out. So it's a kind of plug figure so that we make the balance sheet balance again. And of course, we always have to look at, can we obtain the finance? Are we credible enough to get the finance? But this is something we deal with when we do the task. So let's now look at a task that we have here. It's quite extensive. And we have the different items that we now have to solve and have to have a look at. So let's start. We see we have a 10% sales growth from 800 to 880. Cost of sales are directly linked to the sales, so they would also grow by 10%. So plus 10%. This minus this gives us the gross profit. And this also grows by 10%, of course, because it's related to the sales itself. Then we go to selling and administrative expenses. Now we already have the costs split up, so it's very easy for us. We don't have to do anything with this. Usually here we would then have to use the high-low method or linear regression, but in this case it's already done for us. We know 60% are fixed, 40% are variable. So basically this means for us that only the variable part, the 40% that are variable, increase. So if we have 100,000 in costs, we know that 60,000 are fixed and 40,000 are variable. And if only the variable part increases by 10%, then 40,000 plus 10%, it would actually mean. So the variable cost increased by 10%, and so let's say we have in total 100,000 in costs. From this, we have 60,000 fixed. We have 40,000 variable. Then only this part increases by 10%. Then we have in total 44,000. And if we add the 44,000 basically now to our fixed costs, we would have 104. And you can see that here. Then we go to the operating expenses. It's 100% fixed, so this doesn't change. And then basically gross profit minus these two gives us 96 is the operating profit that we have. We have a tax rate of 25%. So this means 25% of this gives us 24 that we have to subtract. So 96 minus 24 gives us 72. The company has a rule of giving out 50% of the profit after tax as dividends. So 50% of this is 36, leading to retained earnings of 36 as well. So then we go on further with the balance sheet. Well, the non-current assets basically do not necessarily increase with the sales. We see here non-current assets run at full capacity. So this means, well, we have to get new ones. And if we increase our sales by 10%, we also need then, if we are at full capacity, to increase the non-current assets by 10%. Otherwise, we cannot support the growth. So this plus 10% gives us 176,000. Well, we said all the current assets, all the working capital items also increase by the same growth rate, because otherwise we cannot support the growth. So this, and this all grow by 10%. So 10%, 10%, and 10%, leading to total assets, so this plus all the three others, of 770. Then we go to non-current liabilities. Share capital is unaffected, because basically we don't know if we need more financing or more shares into the market to finance the growth. We said later, or you can see also here, the additional financing is covered by a loan. That's why we do not need additional share capital. Well, retained earnings were 290,000 before. Since we made a retained earnings of 36 this year, basically in year 9, we also need to add this to our balance sheet, because that's the total retained earnings, and that's the yearly retained earnings. So that means this plus 36 is 326. So this in total leads to this plus this leads to 486. We say loan is a balancing figure, so we do that later. Then we look at trade payables. This is also a working capital item, so also current liability that has to increase by the increase in sales, so plus 10%. And then the tax payable is basically independent of the sales and is 50% of the tax expense. Tax expense is 24, 50% of that is 12, leading to a total of 770, which is simply total equities and liabilities. So this plus this plus this. But wait, this is not true, because it doesn't balance. And that's why we need the discretionary financing here. Basically, if we get a loan of 8,000, this plus this plus this plus this is 770,000. So this is simply the balancing figure, the plug figure. So you see this plus this plus this actually gives us 762. So we need 8,000 to balance this out. That's the way we have to use the discretionary financing. All right. Then we also have to look at the cash from operating activities. Well, cash flow statement, we dealt with this a couple of weeks before. And so we can now basically forecast the whole cash flow statement. But the difficult part will be the cash generated from operating activities. And here, well, we actually start with the earnings before interest and tax. So we go back once, and we know we don't have any interest. So that makes it easier for us. But we have earnings before tax, so 96. That's the starting point. That's the starting point. And then we know we have to add back the depreciation and amortization. So going back to the other overview, we don't have that listed. It is probably somewhere in the expenses, but we don't know that. In this example here, you can also see that the assumption is that depreciation and amortization is the non-current assets divided by 8, which is basically the amount of years that we use the non-current assets. And that's something that the company, let's say, looked at in the past years. They always had a, let's say, the useful life of the non-current assets was always 8 years on average. So that's why they say, well, we simply take the total value of our non-current assets. We know we have an average period of 8 years for our useful life. So we simply take that. And if you now go back to the non-current assets, we see 176. And if we divide that by 8, 176 divided by 8 gives us 22, which is then the amount of depreciation we have to add back. This is a bit tricky, but if you would have the complete picture also of the last years, you would see that basically the useful life, you could calculate what the useful life was and then see, well, it was always on average 8 years. So we simply divide that by 8. So we have an increase in inventories. So if you go back, and I just dropped my pointer, if we go back to the overview, we can see inventories increased by 32. And if we have an increase in inventories, it means we spent money on the inventories. So we have to subtract it because this means less cash. Increase in receivables means the same. So more customers didn't pay us yet. And an increase in payables means more people allow us to pay later. There is a positive impact on cash, leading to a forecasted cash generated from operating activities of 90 million. And that is basically the way that we project the operating activities. All right, so this was the content of this week. One more addition, if you want to calculate the linear regression with Excel, there are some tools for that. It's the data analysis tool. On the next slides, you can also see how you could install it. It's just a work through. And looks complicated, but it's quite easy. There are also a lot of YouTube tutorials that explain that to you if you want to calculate the linear regression with Excel and not with a calculator. But since you don't have Excel in the exam, of course, you can't use it for the exam. Well, for the tutorial, please have a look on the portal. There you can find a worksheet. And this is what we're going to do in the tutorial. Thanks very much for listening and have a good further day.